you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Aloha, everybody. This is Harold Green of Bright Tree Financial Group, and it is time to stop doing what you hate. I hope you are having a fantastic day. I hope you're having a phenomenal day. I hope you're having a big, bold, and beautiful day. In one of my shows, I talked about getting up on the right side of the bed every day. And that's more about your attitude than anything. But for some reason this morning, I woke up, I found myself extremely happy. And I kind of know why, but then again, I don't know why, because normally when I wake up, I don't get giddy or anything like that. I guess I slept okay. I normally get up with thinking about what it is that I got to do, what it is that I have going on that day, are there any problems I need to solve or anything like that? And so, I'm very methodical. I get up, I do my devotionals, I do some research, and I hit the gym and things like that. And then, I get on with my day. But today, for some reason, I woke up and I was pretty excited. I'm going to be meeting some friends for lunch today and just kind of hanging out and then trying to enjoy the weekend because there's been a lot of stuff going on. And so what I want to talk about today is I want to give you a market update, a stock market update, as I normally do periodically, and just kind of let you folks know what's going on. It's been a very, very interesting week. I would say it's been a very, very interesting year. And there's been a lot of professional investment advisors who got this thing, they got it wrong. They got it wrong in a major, major way. And as I was sharing with my clients the other day, and before I get into this, investments do carry risk of loss. Do your due diligence. Make sure you understand your risk tolerance. Make sure you have an independent investment advisor look at what you're doing, talk to them, make sure you're getting the correct advice when it comes to the market, because it does carry a risk of loss. You can lose money. People do lose money, although they make money, that you can lose money. So all investments carry the risk of loss. So make sure you understand that before you get involved in any investing. And anything I share with you today is not to be taken for investment advice. Do not go and act on anything that I say to you in this show without sitting down with a professional and talking to them about it first. Now, if you do act on anything I say in this show, that's on you. If it works out, great. If it doesn't, that's on you. It's not on me, okay? So I'm just going to put that out there right now before you go and start trying to trade on my information that I share with you. This is not meant for that. This is just meant to give you an education and a snapshot. And if you are a client, you do get my market minute. And if you haven't subscribed to it, let me know. And then Beverly can kind of get you on, get you set up for it. And, we can go from there. So let's get into what's been going on. All right. You ready? 1, 2, 3. Let's get it. Let's get it. Let's get it. Let's get it. What's been going on? So like I said earlier, a lot of the top dogs in the industry have gotten this thing wrong. And it's funny because as I was looking through my notes this morning and trying to prepare what I wanted to talk about, one of the things I found is that a lot of these big institutions, they all kind of herded themselves together. They all were out there parroting the same thing. They were all out there saying, the recession is coming. The recession is coming. Last year, it was kind of like, okay, at the end of the year, we're going to go into a recession. It's going to be deep. It's going to be bad. It's going to be ugly. So run for the hills. Go hide all your money. Go buy gold. Go buy bonds. Go buy treasuries. It was just a lot of stuff they were saying. And it was interesting to me because I subscribe to technology that gives me the breakdown on fund flows, right? Money going in and out of funds, money going in and out of stocks. So I can see the big institutions who are buying and who are selling certain positions. And so it was interesting to me that they came out on TV and they said one thing, but behind the scenes, some of them were doing something totally opposite. While they were telling you to get out of this market, get out of the way because it's going to be bad, they were buying in. It started last year back in October, right? And if you go look at any chart, you'll be able to see what actually went down. If you can just go look at any chart, you'll be able to see what happened. And so I thought that was interesting, when they were out there saying one thing, they were doing something different. It lit a fire in me And I began to share with my clients what my thought process was back then. And I told them, this is not when you want to get out of the market. The market's down right now. And these guys are driving it down further by the crap they're saying. The Fed was raising interest rates left and right, hiking like crazy. We had the war going on in Ukraine. Everything was looking very, very bad. But as you know, when things look the darkest, it's like the light can be right there on the other side. And if you look at your time horizon and you understand this one thing, if I got $1 million on my portfolio and I lose 30%, how fast is it going to take me to recover that money? Right? When will I need it by? What's the strategy to recover? And so at the end of the year, we put together our options trading strategy. We rolled it out to our clients. Pretty much everybody got on board, and we did pretty well with that. We were buying in when everybody else was saying sell. And we just started with a small amount of options in our clients' portfolios just to get people to understand how these things work. And then from there, everybody started to get more comfortable with it. We added a little bit more to it each time, to the point where we went from being 1.5 million in options to, I think Friday we closed at 17 million in options growth or whatnot, or thereabout. So I would say it's probably between, I would say conservatively about 10 to 15 million in options growth. And this is just return over the last 5 months or so. Now, that's not including the growth that was on the regular holdings that was in their portfolio. And you might wonder, why in the world would you do something like that? Because it's extremely risky. I had clients telling me, I don't want options because they're too risky. And I said, one of the things you have to understand is we lost money, but if you don't do what you need to do to recover, then it's going to take, heck, five years in some cases. And a lot of these fund managers were heavily under invested in the market. And then some of them were heavy short the market, which means you can look it up. They shorted the market. They were bearish on the market, and they shorted the crap out of the stock market. And so therefore, when they were shorting the market, they're the ones on TV saying, hey, sell, because they know if you sell, they've already shorted the stocks, right? That drives the value of the shorted positions higher. You make money when the market goes down, when you short stocks. If you go long and you buy the stock, you're bullish on the stock, which means if the price of the stock goes up, you make money. But if you shorted it when the price of the stock goes down, you make money. So it was so short, and that's what was going on. You can look up short interest in any particular stock, and then you watch TV, you watch news, you watch analysis, and you understand what these people are doing. This is not a fair fight. I'm going to say that to you again. This is not a fair fight. You're going to have to understand how to beat David in this situation with your slingshot and your 3 smooth stones. And you're going to have to understand how to fight these giants in the market. You're going to have a certain kind of mindset where you want to persevere and you want to be contrary in a lot of these situations. And we were. I took a lot of heat over it. People left me. They acted like I didn't know what I was doing, right? Because you hear these guys and I just said, okay, whatever. I understand. There's too much herd mentality out there. Too many people going along with getting on the bandwagon. I said, whatever, right? So basically, with that being said, a lot of stuff went down, right? And when we look at all of our positions today, we created a strategy where we're playing the major players in the market, large cap, domestic US, high revenues, high cash flows, low debt. And then we also got involved in the AI a little bit early on. And when things started going up, when the shorts were having to cover, and this is what I was telling my clients, the shorts are going to have to cover. Because as soon as this market takes off, as soon as there's a hint that it's going to rebound and things are looking good, there's going to be trillions of dollars coming off the sidelines, and that's going to force the shorts to have to cover their shorted positions, which means they have to now become buyers and buy that stock back. And when they did, I mean, it was entirely brutal. And so what do we do moving forward? How do we play this market going forward? Well, what we are doing is we're simply taking monies off the table in certain stocks because the price of the options have become expensive now. Before, when the stock prices were down, the options were really, really cheap. You could get a Tesla option for less than $1,000 or a contract. It was insane. And you say to yourself, why in the world is this happening? And you just kind of look out there and you look at what's going on, and you just kind of see the stupidity that's going on in society, and how people are, playing these games with politics and stuff like that. So one of the things I say, do not play politics with your portfolio. If you're investing to make money. I was talking to a client the other day, and they're heavily long in one particular position. And, they were looking at adding more to the position. And I said, let's take a step back here. What are you trying to do? Are you trying to say, I own a gazillion shares of this company? Is that your end goal, is to own a gazillion shares of this company? Or is your end goal to get the greatest return on your portfolio that you can possibly get? And I said, or is it a combination of both? And I said, if it's a combination of both, this is how we need to approach our strategy moving forward. And folks, one of the things about investment strategy is this: you always have to sit down on a weekly basis and review your investment strategy. That's if you're doing it on your own. However, if you're working with a professional, you have to understand whether or not that professional is adjusting their investment strategy, or they following the crowd. What are these people doing? You're paying them a fee. I get paid a fee. My fee is not cheap. My fee is on the higher end of what investment advisors can charge. You can go look at my ADV and it shows you what my fees are. And some people have told me, you charge too much. We're going to leave you because your fees are too high. Fine. But you're not going to get anyone trading options in your portfolio and busting their tail to chase your options or your performance for 1%. If they do, God bless them. But I normally don't see that unless one or two things is going on. They're managing a few $1 billion and they have a very high entry point for you to come on board, because then it's worth it for them. They have billions of dollars that they manage. But do you have the minimum 1 million, 10 million, 20 million to get involved with a firm like that? Normally, firms like that don't charge 1%. They charge 0.5% or even 10, a tenth of a percent or whatever it is, right? 10 basis points, 10 bips, because they have such a huge fund and they have a team of people managing it, and they're collecting hundreds of millions of dollars in fees every single year. That's what you have to understand. But if you're working with a regular investment advisor and they're only charging you 1%, here's one thing you got to look at. What are they putting you in, right? Are they squatting on your portfolio for money? In other words, are they simply just buying mutual funds and putting you in mutual funds and telling you that, hey, this is a well-balanced fund. It's, and some people like that. That's their motto. They only do mutual funds. But I will tell you one thing for sure. Based on past performance, which is no indicator of future results, I have never seen a mutual fund outperform a certain amount of stocks, a certain sector of stocks over a period of 5, 10, 15, 20 years. They may not lose as much in a short period of time, but they sure as heck won't cover the ground that the individual stocks can cover. And when I break down a lot of these mutual funds, what I find in here is this. I find that a lot of the mutual funds are top heavy, the fastest growing tech stocks that are out there. They're top heavy. You'll have an index fund that's top heavy, Apple, Microsoft, Nvidia, on and on and on and on and on, top heavy. And a lot of these mutual funds have different ticker symbols, but inside they're holding the same stuff in concentrated amounts. So when people tell me I'm very well diversified because I got 10 mutual funds, I say, well, your 10 mutual funds, if I break them down and plug them into my Morningstar tool, they're all holding the same stuff. And I said, look at the drag on your portfolio. I don't know if you guys understand what drag is, but there's another term for it. But I just use the word drag because a lot of people understand drag. It's like having a parachute tied to your back. It's drag. You can't go as fast, right? When you combine all of these stocks and you mix them in with a bunch of non-performers just to diversify the portfolio, you create drag. And sometimes, or in this case, it's not necessary. And so our process in the Rapid Retire financial planning process is very simple. Cash flow management, income generation, cash flow management, income generation, cash flow management, income generation. That's what we want. And then adequate cash reserves. So that will allow you to take more risk in your portfolio than, say, someone who doesn't do all of those things, right? Because you're hedging, you're watching out, you have a great cash reserve system. And so one of the things we're doing now, we're creating guaranteed income for clients because we're chopping off the tops of their investment portfolios. I'll give you an example. Let's say in your portfolio, you have the short term, the long term, the immediate, intermediate boxes or buckets in your portfolio. The short term portfolio is for money that you're going to need in the next 5 years. Intermediate portfolio is money that you're going to need 5 to 10 years. And then the long term is 10 to 15 years. So what we also have in there is this. We have the ability on the long-term portfolio is to trickle down that money into the short-term buckets. Now, one of the things we're doing with the short-term bucket is we're creating another short-term bucket where we have guaranteed income that goes to a client on a monthly basis that does not change. It's consistent. It doesn't go up. It doesn't go down. It's guaranteed for a period of time. So every time, let's say the portfolio is $1 million and our base is $1 million, every time it goes up 100,000, we can chop that off and put that into another bucket and then turn on an income stream. This is what we're going to be doing to take advantage of the bull market that we're entering into. Yes, they have now officially said we've entered into a new bull market. I believe that happened last year. But there was so much negative news, it just got overlooked. And everybody was sitting out there on the sidelines with their cash and treasuries and things like that because they kept saying, don't buy this market. Don't buy this market. These stocks that you see going up, that's short term. That's a bear market bounce. That's all that is. It's a little bear market rally. That's all that is. That's what you kept hearing over and over again. So one of the things when we see things like that, we're contrarian. So we want to start to create more income streams for clients, guaranteed, so that they don't have to worry about watching their portfolio as close. Because if you know you have a guaranteed pension, you live a little bit differently. Now, I'm not saying, right, we want to put everything in guaranteed money. That's not it. It's just going to be a small part of the client's portfolio moving forward. That way, we can still continue to grow the long-term buckets, grow the intermediate buckets, grow the short-term buckets, and then set up these guaranteed income buckets so that people don't have to worry. Now, one of the things that's very interesting, when the market is going great and it's going gangbusters, no one really calls me and says, "Hey, yeah, I want to take some money off the table because it's doing really well." Most people want to let it ride. They want the growth, they want the gain, but I'm going to say something serious. This is when you begin to take some off the table and not get greedy, right? Greed is the enemy here, okay? In a great bull market, greed is the enemy. It's the enemy to your success. In a bear market, fear is the enemy to your success. The market is driven by fear and greed. And right now, there's a lot of greedy people out there trying to get in and get stuff. And it's like, wait a minute, okay. You were extremely fearful and now you're extremely greedy. And when the market does those two extremes, that's where options become very valuable, a very valuable part of your portfolio, because the more volatility in the market, the better the options perform on the upside and then also to the downside. So if you're interested in that, adding these options and guaranteed incomes to your portfolio so that you don't have to worry about it, click on my show notes, get on my calendar, and then we'll do a needs analysis. I'll review your positions. I'll review what you've been doing and then tell you the inefficiencies in your investment strategy. And then if you want me to change it and work with you, you will see my fees in the ADV. Yes, they are higher, but normally it's because I'm an active money manager. Active money managers do better overall in these kinds of markets than the buy and hold strategy, where you're just buying a couple of stocks and you're holding them. Rotate, rotate, rotate. That's my mantra. Rotate, rotate, rotate. The portfolio does well, chop some off, rotate that money into something different. Okay. So we're always going to have to start making these adjustments. Now, I always talk about Tesla because it's a prime example of how fear and greed really just it shows you everything right there. It has some of everything built into it. Is it an AI company? Is it a technology company? Is it a car company? What is it? Well, it's a cash cow is what it is. They make money hand over fist, left and right. Some people don't agree with them plundering the earth for rare metals to make batteries, but hey, when you start talking about climate change and doing things for the climate and you say EV is the best option for, to help climate change, you can't have it both ways. You can't say you want a sustainable planet and then, EV, you got to understand the whole ball of wax. All right. So let's go back and look at Tesla real quick because I want to talk about that. Last week, I think I put out a market minute and I make sure that with you folks on my podcast show. So you can just kind of see what I share with my clients in a video format. And you can see the charts and different things like that. Here, I'm just sharing data with you and you're just going to have to listen along. We were talking about resistance levels, right? Pivot points and resistance levels. And a great example of this can be found on barchart.com/stocks/quotes/Tesla/cheat, the word cheat, and then -sheet. Barchart.com, stocks, quotes, Tesla, cheat sheet. And what it does is it kind of shows you the resistance points like 0.1, 0.2, 0.3. And what I share with my clients is, we're down here at 200 and something dollars a share, or whatever it was, 217 or something like that. And it's like, hey, if it breaks through this, here's the next one. Boom. It breaks through that. Here's the next one. Boom. If we break through the third one, boom, all bets are off. This thing is going to run. And sure enough, that's exactly what it did. And thankfully enough, we had put our options in place months and months and months ago before we even got here. So I'll give you an example. We had the Tesla July 21st, 2023. I think it's July 21st, something like that. The 195 call. And then I had some 175 calls in there. And I bought those back in April, I think. And, they were kind of cheap. And they were, I had some time on them. And what happened was Tesla went backwards really bad. They came out and they were talking about, the prices going down of the cars. And they were talking about just all these crazy things, that was out there in the media, right? And so with that being said, it drove the stock down. And then so went the options with it. But just in a short period of time, those July 21st, 195 calls, 195. Okay. Right now, it's going for $53.68 per contract. Back then, it was only like $1,000 or so per contract. Right. And so, well, actually what it is it's 53. I think it was like $100 or something like that. Don't get me wrong here. Let me see if I can fix what I'm saying. The price now for one contract is $53.68. The price back then for a contract was like $10 or something like that. So you multiply it by 100 because one contract allows you to buy 100 shares. And right now, so if you wanted to buy, say, if you wanted to buy 10 contracts of that stock, basically it's going to cost you quite a bit. Okay. It's going to cost you quite a bit for 10 contracts. All right. So things like that. And those things have ran. And we'll still have a little bit of time on it because we have until the 21st of July to actually exercise that contract or to sell that contract for the profit. And so right now we're pretty big in that contract. I think I sold all of mine just to take the profits and I rolled them into something different. But you must have something like this, even on a small scale, in your portfolio in a bull market, right? I'm just going to say, I feel very strongly about this. You must have something like this, even on a small level, whether you like one contract of whatever, or two contracts or whatever, because it makes a big difference in the overall scenario at the end of the day. And we have people that are up, my God, 600%, 700%, 800%, and some of these options contracts. And it's like, it feels like we just won the lottery. it feels like we can all just cash it and go home, but no, you don't do that. You basically take your profits and you rotate that money to something else, and you don't get greedy. All right. So if you want me to take a look at what you guys got going on in your portfolios, click in the show notes, get on my calendar with Beverly. We'll do a Morningstar analysis. I'll do that stuff for free, and then I'll give you the report so you can look at it, how you're performing, and then I'll make some suggestions as to what you will need to do if you're working with me. I'm not going to tell you how to go do it on your own, because that's not, I mean, you can do that yourself. But if you work with me, then I'll tell you what I'm going to do, and then you can watch me and see how it goes. And if you don't like it, you can fire me. There is no match made in heaven. Okay. Don't be afraid to fire somebody and hire somebody else if, you're not getting what you want, or they're not delivering on their promises and you're not seeing the results. Sometimes the results will take a little while and you have to be patient, but at least you got to know you have a game plan and that you're heading in the right direction, right? You don't want to give up too soon, but also you don't want to be in something for years and years and years and it hasn't given you what you need. Your money is not working as hard as it needs to work. I tell clients all the time, please enjoy some of this money that we're making, please, right? Because if you're enjoying the money that we're making for you, life is going to be a whole lot better. A lot of people don't enjoy the money that we make for them. Now, I'm not saying go raid your portfolios and go and buy Ferraris and stuff like that. I'm like, no, but you can live a little. You can live it a little. Take some of the profits, live a little bit, and do some of the things that you want to do. Okay, some of the things that are on your bucket list, some of the goals. And for the most part, my clients who are tuned into the Rapid Retire financial planning process, they do live a little bit, right? They do live a little bit. They enjoy. They make sure they take their trips. They do things with their families, right? Because they know you can't take this money with you, right? I call it enjoying life today while yet planning responsibly for tomorrow. And that's as simply that. When you sit there and look at the portfolio every day, go up, down, up, down, up, and down, and that's what you do, man, that'll that crap will give you a headache, And I tell clients, I said, I'm looking at this thing every single day for you. And I see these moves. You might be up 100,000 today. You might be up 300,000 a day. Are we going to pop champagne? No, because you can be down 50,000 to 100,000 tomorrow. It is what it is. But the goal is to be up more than you're down. And that's going to take some time. And we have recovered pretty much everything, with the exception of a little bit. We have almost, I think, recovered everything for the clients who are in the options portfolios, almost everything within 6 months. 6 months from January to June. We've almost recovered everything. We've almost gotten back to where we were at the beginning of January 2022. That, to me, is insane. We're excited about it. We hope it continues, but we're going to be cautiously optimistic moving forward. We're not going to go beat our chest, pound any drums, and do any victory lap. No. It's like, okay, we've done this. Now what's next, right? What is our next move? Because we don't know where this market is going to go. We hope it continues to go up, but if it has a pullback, that's fine. We're going to take our profits and then we're going to get back in. We're going to buy low and we're going to sell high or sell on the way up. And then when it comes back down again, we can do the same thing over again, buy on the way back down. And then, it's just, you can't be lazy with this, right? You can't be lazy. You got to be active. You got to be nimble, and you got to be smart about it. And so I just wanted to share with you folks my insights on it, what we're doing. I'm not going to go too deep into the weeds about the federal funds rate and the dot plot and all of that good stuff. The only thing I can tell you is 200 PhDs plus working in the Fed said inflation was going to be transitory. It was not. They've raised rates the highest ever. But don't let that be a alarm fire for you. Just understand that you're going to have to make certain moves, and then you're going to have to make adjustments in your portfolio. And if no one's doing that for you, please get on my calendar. And if you want to do it yourself, by all means do it yourself, but you're going to have to understand what you're doing. And that's all I'm saying. So thank you very much for tuning in to today's show. And until next time, everybody, 1, 2, 3, let's get it.
This is the podcastfactory.com.